So I'm going to start with the really scary stuff. So let's start on the right way. I didn't have a chance to put any slides together because I was up till late last night finishing a memo on ICOs and corporate and securities laws, which you can find either on LinkedIn or links on Twitter and possibly our Facebook page, and certainly on the CrowdCheck website. And it's titled More Questions Than Answers, and one of my platform clients took a look at that and said, well, that's a scary title. And I said, it's actually not scary enough. And so let's start off by scaring everybody with all of this stuff, because I think that the heading, when crypto and securities collide, is actually a good way of putting it. We are in a situation where it is clear that there are regulations. There are regulations that need to be met. Those regulations were designed for an environment that is completely different than the environment that we're trying to bring about. And yet, if you get it wrong, you could end up being sued. And we'll talk about that in a minute. But I was sort of chatting with some of my colleagues, and I'm like, this is just crowdfunding, right? This is just like the original sort of crowdfunding. I'm going to build a widget, and if people like my widget, they're going to give me some money to help develop it and maybe get a widget of themselves. And in fact, that is what that we have in the case of many ICOs. It is just a product or service development crowdfunding with the ability to trade. And it's the ability to trade that makes this whole thing completely different than things like the Pebble Watch. I just want to go through some of the issues that I mentioned, that I discuss in the memo. So we've been hearing a lot about when do securities law apply. Of course, it is when you have a security. Am I going to tell you whether you have a security or not? No, I am not. You can go online and you can get advice from Paris Hilton as to whether something is a security or not. By the way, the SEC said, don't rely on Paris Hilton. They put out a bulletin recently saying, don't take your securities law advice from celebrities. And she was one of the ones that they were thinking of. But although I can't right now tell you whether or not the thing that you are developing is a security or not, I just want to throw out a few thoughts. Everybody's been citing this case Howey. Everybody's been citing it as if it were the only thing that determines whether something is a security or not. That is not the case. There are several different Supreme Court cases that tell you whether something is a security or not. And there are a lot of cases from the lower courts, that's the courts that aren't the Supreme Court, that interpret those tests further. So if you've just got someone who's going, oh, Howey's got like 4 elements and boop, 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 we don't comply with any of those, that is a completely inadequate analysis. Can you call the SEC and say, can you tell us whether we have a security or not? The answer that you're going to get from the SEC, and I think we've got some SEC folks in the room. Did I hear an SEC conversation from somewhere over there? Yeah, they're smiling. But the SEC's response is most likely to be, this is always a facts and circumstances analysis, and your lawyer, who, by the way, gets paid more than we do in many cases, is in a much better position to determine whether something is a security or not. I've been asked about whether you can go to the SEC and get no action letters. It's probably going to take longer, be less successful, and cost more to get a no action letter from the SEC on whether your thing is a security or not than if you just complied with the securities laws in the first place. Bear in mind that the SEC is not the only regulator. Even though state securities regulators very frequently follow the same definition of whether something's a security or not all of them do. And there are some states who take the view that any form of risk capital, that is, you're putting money in, and whether you get money back or not, depends on whether somebody, on the efforts of a third party. They see those as securities too. So there are some state regulators who reckoned that the Pebble Watch was an offering of securities. Another important point is that the SEC is not the only plaintiff. They're not the only people who can sue you. The people who can sue you and are most likely to sue you if something goes wrong, are plaintiffs' lawyers. And we know of a number of plaintiffs' lawyers around the country who are just basically collecting lists of ICOs and going, I'm going to sue these people. And they're going to sue not necessarily just for saying something wrong. They can sue for unregistered offerings of securities. So if your token or whatever was a security, wasn't registered or made in accordance with an available exemption, they can sue to get the money back with interest. And there are lawyers out there who are planning that right now. Just a few other things that I wanted to hit in the scary category. Pre-sales are still sales. We've been seeing a lot of this sort of like, oh, we're doing a pre-sale, it's not a sale of securities yet. Yes, it is. You're taking money for giving people a thing, a right, that's a sale. And it's not so much that it is, it's a pre-sale, it's a sale of a pre-thing, because the thing doesn't exist yet. We're also noticing that when we look at some of the SAFTs, the simple agreements for future tokens, there's a huge amount of uncertainty there. When you compare it to its cousin, the SAFE, simple agreement for future equity, in a SAFE, you kind of know what you're going to get in the future. You know that there's going to be an investor, and the investor's going to put together an offering, and it's going to be of preferred shares. And preferred shares have certain rights with respect to dividends and voting and anti-dilution. With respect to the SAFTs, it's kind of, hey, we're building a thing. It's got some rights. Don't know what they are. There's a huge amount of uncertainty there. Then I want to raise a question that I have raised with my friends at the SEC, which is, okay, so it's a security. What kind of security is it? Is it debt? Is it equity? Is it another thing? I don't know. Talk to the regulators, and the regulators say, well, you might want to talk to the accountants. Talk to the accountants, and they'll say, I don't know, what do the lawyers think it is? So there's a huge amount of uncertainty there. Then getting into, okay, you're now compliant. What are the limitations on the various options that you have for complying with securities laws? You can choose Regulation A, which is my favorite. I love Regulation A. I think it's very appropriate for this area and for crowdfunding and for emerging companies in general. But Reg A comes with some restrictions, like you can't do early bird pricing. The way that you do early bird pricing or stepped pricing of any kind is that you go out with one price. When you've sold there, you refile and get qualified by the SEC at the next price. There's an element of timing uncertainty there. You may also need to engage brokers for Reg A offerings. I don't know if Victor's got any views on this, but brokers are being very cautious about this whole area. They're a little bit leery. But there are some circumstances in which you can't sell into a particular state unless you have a broker or you file for yourself to become an issuer dealer. Another option that you have in compliance is Regulation CF, Regulation Crowdfunding. This is the teeny tiny one. This goes up to $1 million. There are restrictions on transfer of Reg CF securities, which means that when you build your smart contract, you're going to have to make it, build it in some way so that it can only be transferred for the first year to the people to whom it's allowed to be transferred to. Got a bit of a problem with the whole anonymity issue there. There's also the problem that in Regulation CF, the funds must be held by a qualified third party or a bank. Smart contracts are not qualified third parties. There's going to have to be an answer to that somewhere in the when you're putting together the deal. Two more regulations that you might comply with in trying to stay compliant. Regulation D, this is the one where you sell to accredited investors only. Those securities are restricted, so again, with the smart contract, you're going to have some way of monitoring the number, the identity of the persons to whom the securities are transferred. Particular quirk with respect to Regulation S, which is the one that says if you sell outside the United States, you don't register with the SEC. That one treats debt and equity securities differently. So whether something is debt in which case it's got a 40-day period in which it can't be transferred to US persons, or equity, in which case you've got a 1-year period, you're going to first have to work out what are you selling and then work out how to comply with it. And then I just wanted to leave you with the Section 12G problem. Section 12G of the 34 Act, the Exchange Act, says that if you have a certain number of shareholders and 10 million in assets, then you have to register and become a fully reporting company with the SEC. There is a conditional exemption for Reg A securities, which applies so long as you don't have more than 50 million in revenues. There is no exemption for Reg D securities. So if you do a private placement to accredited investors only and you acquire more than a certain number of shareholders, which is 2,000, no more than 500 of whom can be non-accredited, you're supposed to become a fully reporting company with the SEC. And you really don't want to do that because you're probably not ready for that. And so hopefully I've scared you enough. There are, go take a look at the memo. It's going to expand to include even more questions and unanswered issues. If you've got any questions for me to add, please drop me a line. Thanks.